Hi, welcome to the show. My name is Mina Rickey,
And I'm Lidiya Korzhuk.
and today we are interviewing Bill Ham, and he is the Chief Operating Officer and the driving force behind Broadwell Property Group. He's also the creator of Real Estate Raw, where he teaches people how to invest in multifamily real estate.
He has upward of 20 years experience with a proven track records of identifying, acquiring, operating, and divesting of ranch footprint of multifamily housing.
Bill can be seen and heard on countless podcasts and webinars, as well as standing on stage giving presentations at trade shows and other forums, both online and off.
Ham is a real estate entrepreneur, a sought-after speaker, an author, and an operator, but his real passion lies in education. He has been a coach and a mentor to the future titans of multifamily.
Over the years, he has counseled hundreds of students who have gone on to close countless millions of dollars in their own deals, many crediting Bill with their success.
Bill was born and raised in Middle Georgia, where he honed his craft, opting to move to big city of Atlanta in 2015 to expand his reach.
He has a wife, Yvonne, and two dogs, Jake and Lola. He loves gardening, water skiing, and hiking. Welcome to the show, Bill.
Welcome.
Thank you. Thanks for having me on, ladies.
Well, right now market is totally different when we started in the real estate. So I want to start out. What's your thoughts, Bill?
Told you so.
Told you so.
I'm just going to lead out with that right there. I've had that in the barrel for a while, right? I've been
I know.
Not,
You were
not
holding
to
it
the
in.
two of you personally, but just the world in general. Told you so. Right. Market cycles. I have talked about this, and it's interesting now when the cycle is now incredibly apparent. But when it wasn't apparent 2 years ago, and everything's going great, and I'm going, hey, you all still need to stick to the fundamentals. You need to know what you're doing. You need to know how to underwrite a deal. I understand the rent went up 25% last year, but that's really weird. You can't underwrite deals going forward for every 25% rent. And I was trying to tell everybody to kind of sober up and calm down and make sure you're sticking to the fundamentals. And I think a lot of people looked at that, as me being wrong or maybe fear mongering or negativity or whatever the case. And it was just 20 years of experience saying, hey, this market has gotten abnormally good. That's great. But at the same time, let's stay, sober here. And I think a lot of people ignored that information, did deals they shouldn't have done, got loans, short-term loans. And that's really what a lot is affecting a lot of the market right now. But we have a lot of short-term loans coming due. And I think that now the market cycle is becoming obvious. People are going, "Oh my gosh, this is genius." No, I've always been here saying this. It's nothing new. You just weren't listening. And now the market cycle is obvious. So that's where I'm kind of saying, "Hey, I told you so." But I've even written books about it.
We have them.
Really?
You might have read that.
right here, these two.
Bill,
Thank you for that.
let's talk about, why don't you paint a picture of what we're talking about? Let's talk about the last 3-4 years in the
Absolutely.
multifamily. Let's talk about what's going on right now, and let's see what is coming according to what you have seen
My
in the past.
opinion.
What do you think where we're
Absolutely.
heading to?
Yeah. So capitalization rates have been compressing for the last 15 years, really. I mean, notwithstanding just the last few years. Yes, and when we talk about cap rates, that's sort of the price going up faster than the revenue going up, right? So we're just paying more money for less cash flow. And we've been seeing that pattern go on for about 15 years, heavily since the sort of '08 cycle. Okay, well, if we look at that model and we take it all the way out to the end, cap rates keep going down. That means we're headed for one of two things. Either the American multifamily market is going to give up on cash flow, or we're looking at a market shift, one or the other. It's a paradigm shift or a market shift, because if you keep taking cap rates at that pattern, they go to zero. Cap rates at zero means we buy and sell real estate for appreciation only, never again for cash flow. I doubt that. Now, not to say that's a crazy concept. There are plenty of countries and plenty of even cities in America that basically traded at no cash flow appreciation only, right? I'm just saying I don't think the average meat and potatoes piece of real estate in America is going to go there. Therefore, we're looking at a pattern shift. And that's where we're, instead of a paradigm shift would be, we just all give up on cash flow. I don't see that occurring. Could happen. I'm going to bet not. That means we're going to have a price shift, a market shift. And that means cap rate decompression over the next cycle. Therefore, owners are going to have to hold on to those properties a little bit longer and let the rents go up to get the valuation out of it. And those who have short-term loans are going to find themselves exposed, maturity exposure, those short-term loans coming due. And if they got these loans 2-3 years ago in a very low interest rate market, 4% interest rate, right? And now all of a sudden that short-term loan is maturing and you have to pay the loan balance off, and you go to refinance, like the BRRRR model, right? Buy, renovate, refinance, run off, whatever. Now you go to the bank and you say, hey, I want to refinance this property. Well, you're going to have a debt service coverage ratio problem. The interest rate went up. You went from a 3.25% interest rate to a 7.25% interest rate, and your rent didn't go up at the same pace. So that's going to be a cash in refinance, not a cash out refinance. And right there is where I think we're going to see a lot of turmoil coming due soon. Right now, we're literally in October at the time of this recording, and we are calling this Red October. We've been talking about this for some months now. This month and next month, October, November 2023, we have over $8 billion in short-term loan maturities hitting the market. What are the banks going to do? Well, extend and pretend some degree, right? They're going to just extend those loans and work things out. But I believe there will be equity injection, meaning capital calls. And I think we're going to see a wave of foreclosures as well in the multifamily space. So that's what I think we're headed into, but it's going to be a good thing. I know that kind of sounds negative, but it's actually not. I think we're going to see big price correction, which means if you're on the buy side or you're learning to get in, now is when you want to be putting both feet into the multifamily market, the education side, learn what you're doing, build relationships. Right now is when you've got to be building momentum, not taking breaks, not taking hiatuses.
Correct.
Because you need to be getting in and keeping those relationships. Now, if you've got real momentum in the multifamily market, then I'm saying, yeah, right now is not the absolute right time to buy. Probably want to give that, I'm saying, me personally, Q1, Q2 next year. So March, April, May, June, 24, I am predicting that's where you're going to see the wave of deals starting to hit the market. So those are my opinions.
Go ahead.
Because the owners, and this happens across all asset classes in real estate, the owners haven't got the memo yet. They are holding on to their prices, what they think in their mind, the market values their assets right now. So they don't want to give them in at the real price. And I see that as a
Yeah, that's true. A lot of owners, they think that, market's gonna stabilize, the interest rate's gonna lower, that's not gonna happen. What I want to ask you is this: you mentioned about short-term loans. Well, I have a whole bunch of investors telling me, but Lidiya, in commercial, every loan is a short term, 5 years max. So can you define what's a short term loan in your opinion?
Yeah, that's actually a really good point, a great question. So and this is what I teach, all of my students and everybody in the multifamily space is all of these loans are debt service ratio loans. And they're also what we call balloon notes, BALLON. I know my accent's bad sometimes. Balloon notes, not blue, balloon notes. And meaning they are not fully amortized, right? A fully amortized loan is more of a consumer loan, like for your car or for your house. You make every single payment. The loan is paid off. You own the asset, right? Over here in commercial world, that's not how this works. On average, you're getting a 3, a 5, a 7, or a 10-year loan amortized out at, say, 20, 25, or 30 years. Amortization meaning the payments are as if it were a 30-year loan. Right. So if I have a 5-year mortgage and it's amortized at 25 years, when the loan comes due, I've only paid off 1/5 of the loan balance. Right. So that's a great point. All of our loans to some degree are short-term loans in multifamily in the sense that they don't pay themselves off. If the deal just paid itself off, like you could really just set it and forget it, then this really would not be a very difficult business. All you'd have to do is simple income approach. Say, hey, the deal cash flow is great. Hold on to it for 30 years, pays itself off. You're good. It's not how this works. So I am saying short term in the sense of maybe 2 years, 2 years or less, 2 years. That would be short term, but that's not even really a good enough answer. I would have to ask, what is the exit strategy of the deal? So if I'm going in and I'm doing a heavy renovation, fix and flip, then 2 years is a fine loan. Saying, hey, I'm going to buy this property I'm just going to go in and raise the rent and there's no real value add to it. And I'm going to refi and pull all my money out because the market's just going to do magical things in the next 2 years. Yeah, that is a short-term loan. That's where I'm saying, hey, don't do. So I'll put it more like this finally here. When you're using a loan to justify the price, you're making a mistake. Right. So if you're saying, hey, that purchase price is too high, but I can get an interest only low down payment, this kind of outlier loan, and that allows me to pay that purchase price, you're making a mistake. You're using finance to justify a purchase price. That's always a bad problem. So don't do that. Then you'll be right.
Hey, Bill, I started learning about multifamily in 2020 during COVID. It was during COVID because everything else was shut down and we had to occupy our
Sure.
minds doing something. And what I saw in the last 3 years is that a lot of people had a lot of money available to them. So the safest place to put your money is real estate. And why put it in one house if you can put it in a 10 house complex? Okay, that's the logic behind it. So these people are in trouble now because now they have to pay their short-term loan. What would you do if you were one of those folks? What would be a next strategy? Would you start freaking out now? What would you do if you were on their shoes?
Yeah, it would depend on the certain situation, right? If a seller can sell, then they should certainly consider that. And I think that if a seller has a loan that is coming due in the near future, the one thing I can tell you is that, or tell them listening, is that you have to be pretty sober on the valuation, right? You need to consider that property has probably lost value and that you may not realize some of the profit that you wanted to realize. But hey, that's okay as long as you can be made whole. Don't lose the deal. Don't hurt other investors. If you can do that, then this is just a deal in your career. Don't worry about it. Look, I've had deals that didn't make much money. Big deal. Go on, do another deal. If you've gone past that point, and now let's say your loan is coming due in a time frame in which you cannot sell, or you owe more than you're able to get offers on, you're going to really need to sit down and talk to your bank and try and work out some sort of loan extension. And I would say sooner than later. Reach out to your lender right now and start discussing some extension parameters, what can be done. Try and work that debt out with the lender. Chances are, very good chances are, you're not going to be the only one that walked in their office that day or that week, right? So they've got other borrowers that are just like you on assets just like you. So go get in line, but do it sooner than later because their ability to work things out may decline over time, depending on their own balance sheet, their own financial exposure. So that would be what I would tell you. If you can sell. Don't be greedy. Now's the time to just save yourself. Don't lose money for your investors if you can help it. If you're past that, yeah, go talk to the bank and do that quickly. And next, if this is an LPGP structure, you have investors, or even a joint venture. If you have investors of whatever kind, communication is the most important thing. I've seen this a few times lately where a client will come to me and say, hey, I invested in this deal 3 years ago, and the general partners have been saying everything's great. Oh my gosh, all of a sudden we're halfway in foreclosure and we're having a capital call, and it's a big surprise. And so that's where I think a lot of these general partners have been trying to sweep it under the rug, telling the investors, oh, everything's wonderful, hoping they were going to correct it behind the scenes. And then they run out of time. They were unable to correct it. And now they have to admit that there's been a problem all along. Try not to do that if you can help it. I know it sucks going to your investors with bad advice. Trust me, I feel you. I've been there. I've done it. But it's, like people say, information earlier on is better, right? A negative surprise negative information is one thing. Negative information that surprises you is the bad, right? It's like just try to take that surprise part out, and you'll get a lot more traction out of your relationships.
Setting expectation right and talking ahead of time, possibility, this is what's happening, because I'm noticing a lot of banks are increasing reserves and asking for more reserves, and they have
Yes.
every right to ask for it in every loan. I believe every loan has that little, paragraph where it talks about reserves.
It
And
does.
if you cannot, they can actually start foreclosure process on you.
Correct.
Yeah.
Yep.
So
Debt service coverage ratio. That's the big hidden thing these days, right? Actually, the two most important aspects of multifamily investing, you've already pointed out one of, the balloon note. And the second most important aspect of multifamily investing, unless you're paying all cash, so I'm going to assume for all us mortal people who are getting mortgages and not paying all cash, it's the debt service coverage ratio and the balloon note. Those are your two most absolute critical aspects to understand of the multifamily business. You already pointed out you're going to get a loan. It's a short term, a couple of years. It's not going to pay itself off. Fine. What does that mean? It means when you go to exit that deal, your buyer or a lender is going to evaluate your loan to value on a 1.25 debt service coverage ratio. And so you can always, if you're wondering how much money you can refinance a property for or about what you can sell it for, easy, 1.25 debt service ratio is worth.
yeah.
Very simple answer. Lenders, people, run around saying, oh, the lenders are lending less. No, they're not. They're still lending a 1.25 debt service ratios worth. You're paying too much, right? So what the bank is saying is listen, we don't mind giving you 80% loan to value at this price, which is a 1.25 debt ratio, right? And if you want to pay a whole lot more than that, that's fine too. We're just not going to cover that. We're still down here at a 1.25. So you can pay all the more you want. We're not going to stop you. You're just making that up in down payment. And so now you're looking at 30, 40% down payments. And then buyers are saying, my gosh, the bank is lending less. No, they're not. You're paying too much.
Yeah. Well, a lot of people don't know that you actually went through foreclosure in a couple
Oh,
of
yeah.
your deals in 2012,
Yeah.
So can you tell us what was happening through your mind and with your investors and how?
Okay, well, no investors in that deal. Yeah, except for my dad, no investors in that deal. So luckily, it was not a GP-LP structure, so it was only me alone in that particular deal. But the short, long version of it was I had 2 apartment complexes and houses. They were all 3 separate loans, but with a local bank. I went through one 3-year window, the loan balloon note renewed. And the bank said to me, hey, we want to cross collateralize all your loans. Well, I was young. I didn't know any better. By the way, don't ever let a lender do that. Pro tip. I didn't know that. And so the bank said, hey, we'll renew the loan. Let's just cross collateralize it all together. And I thought, sure, whatever, you're renewing the loan. What do I care? Sounds great. Happy day, blue skies, Well, the next 3 years goes by. Now we've gone through that '08 cycle, and that bank that originated the loan had actually themselves gone bankrupt, right?
Ooh.
And they had been taken over by another FDIC regulated institution. And so the new institution basically said, hey, we don't want to, extend loans and things of the nature. So it wasn't that they called the loan due or came and got me or anything like that. It was just the loan came due, just as we're talking about, right? And I had a debt service ratio that didn't work for the bank, right? As the values had fallen. And that's what the problem was, right? It was a post '08 and the values had fallen and my loan came due. And that's exactly what I teach now. And so short story there. I did a deed in lieu and had to write a check, inject a bunch of capital and still wind up giving the property back to the bank. And that is why I teach market cycles. Which is why I teach the 3 pillars of real estate. And it's in both of the books you have there. It's debt, market cycle, and exit strategy. Those are your 3 pillars, 3 things you have to understand. Where you're at in the market cycle, what's the world doing? What do you plan on doing with that property? Are you going to refi, sell, borrow? What are you going to do with it? And then are you getting the right loan that comes due at the right time and allows you to execute that strategy? If you get those 3 things together, you can mitigate 95% of the risk in the multifamily business. When you get those 3 things wrong, as I did at that point in time, the results are at best gambling. If the market is up, you'll look smart. If the market is down, you'll be exposed. And I looked smart on the first refi, and then my mistake was exposed on the second one. So that's how that works. Market cycles, debt and exit strategy. Yep.
Hey, Bill, we don't even think about some banks going belly up. I know
You better.
Lidiya loves that topic. How do we choose what bank to do business with? How do we know who's good for a while?
Well, that's a great, again, that's a good point. All right, I'll start on a high level, easy answer. Obviously, the larger institutions are going to be more stable. So your top 2 or 3 banks. If we're talking banks now, there's a very big difference between in the multifamily mortgage origination space. There's a huge difference between a transactional lender and a fee-based lender, right? So
Yep.
whether we're talking a bank or a proper lender, right? If you're Fannie Mae, Freddie Mac, you cannot go over to Fannie and Freddie and get a checking account and a debit card. That's not a bank, right? A bank is somewhere you can go in and do other things besides get just a loan. So those are very different. I do not think we're going to see the collapse of any of the larger institutions. Where I think you may see some more collapse is going to be in those mid-level to smaller tier banks that were like the Sun Valley and Signature Bank that we already saw collapse. I think you're going to see some more in that area. I think they're going to be smaller, more regional banks that had too much exposure to office space and over underwrote in the multifamily space and probably didn't qualify some of their assets well enough, got a little too aggressive in lending. I think some of those banks are going to get in trouble. That's what we call a doom loop, right? And that's where exactly what you started to point out, right? The risk tier for that bank increases, right? As they look at their balance sheet and they say, gosh, that apartment complex or that office that we did a loan on, the value of that has fallen. Well, that means their loan face value of the loan has fallen, which means their balance sheet has fallen, which means their risk tier has gone up. And the FDIC says, hey, you now have to hold more in reserves. And what do? They turn around and look at all the borrowers and say, hey, you need to hold more in reserves, right? And they just kick that can right down to us. But they are making us hold more in reserves for these loans because they themselves are being forced to hold more in reserves. The more money a bank holds, the less profitable they are. They cannot sell the money. They cannot make money on the money. So they start to lend less because they're holding more reserves, which causes a lower tier profit, which causes the balance sheet to decline, which causes them to lend less and make less. And they get into that doom loop where they can sort of lend and do less business all the way down into their own collapse. That is possible. I'm not making that up. It's what a lot of economists are talking about that right now.
Yep.
So I think you're going to see a lot of that in some smaller tier banks, not your majors. Loans. Now, once the loan is originated and the bank collapses, that's irrelevant to you technically as the borrower. It's not like, well, your loan just evaporated because the bank institution doesn't exist anymore. That certainly didn't happen for me. I wish it did, right? It's like, don't worry about that, $1 million loan. We're going to call it quits. Yeah, that didn't happen. Somebody steps in and takes over those loans. So even if your institution that you're borrowing from goes under, someone is going to own that loan. In there is the real question. Hey, how do we vet our lenders? Well, think about this. A lender, especially a lot of these mid-tier banks, can sell that loan. So even if you vet the lender themselves and you say, oh, I like this bank or this group or this lending institution, the real question, the real question you need to be asking is, what do they do with these loans on the secondary market? Do they hold them on their own balance sheets, or are they known for selling? If they sell the loans on the secondary market, then you want to find out who do they typically sell to, because you can have aggressive buyers of these mortgages. And now you've got buyers of the mortgage who is more interested in your default than your operations. So you got to be careful what strangers you take your candy from, right? But yeah, not all lenders are equal. So be very careful, and do your homework. Try not to borrow money from strangers. Be my tip. Get references, things like that.
That's a good tip. So I'm going to take you back to market cycles, because
Okay.
it's one of those topics that are so hard to predict. The normal real estate, quote unquote, time frame is between 5 to 9 years, but we've seen some market cycles that go 12 years, 15 years. So how do you know what market cycles you're in?
You look back and go, oh, there it goes.
Okay.
I mean, really, that's the only answer I can give you. There is no way to predict exactly where you are. A market cycle is always a look back, and you say, oh, that was the peak. Oh, that was the right. You can't technically know. You can only generalize where we are based on market criteria. And that's where I'm kind of saying, generally speaking, we're in this market cycle. What I can tell you more specifically is after my 20 years of study in the subject, I realize now a market cycle, especially in real estate, a market cycle is an interest rate cycle. An interest rate cycle is a response to an inflation cycle. So really the answer is watch inflation, watch the inflation rates, and watch the Federal Reserve's response to that inflation rate, right? We started to see before the last election, we started to see inflation start to rise a little. And then we saw, for whatever reason, interest rates being held a bit low for a while through the election. No comment. And so interest rates stayed low for a while. And then we started to see inflation jump up. And that's normal. But then we had this black swan event, this outlier of COVID. And that's where, everybody, if you haven't and you're listening to this and you've not done this, you need to go search M1 monetary supply. One of the first links it's going to pull up is the Federal Reserve of St. Louis, Missouri chart. Take a look at that chart. It shows all, and I think you two have seen it because I think I've showed it to you. It shows all of the money, M1, that the government has put into circulation over the last 60 years. And if you look at it, it's, it's 60. And all of a sudden, COVID, we had more money injected into the system than we've seen over the last 60 years collectively. And they put it all into the system in about 6 months. So that's an inflation cycle. So all you have to look at is inflation. Well, if inflation is at 6 or 7%, whatever it is, it's not, it's 6. And the Feds wanted it 2, then that's real easy to predict when the interest rates are going to come down. Not anytime soon, right? Real easy. People start gambling. The Feds will lower the rates next week. What makes you think that? Why would you think all of a sudden just poofo the Federal Reserve is just going to lower the rate? They're not. It's simply an inflation model. Watch inflation. They'll lower the rates when inflation's under control. It's not. So that's where you need to kind of really look at this, going forward. And so that's market cycles. And I think me predicting, well, let me say this. When we're talking market cycles, you can discuss that on a national level, on a city level, on a even individual neighborhood level, right? So I think on a national level that we've peaked. We're on going into a buyer's market, and we're going to go into a buyer's market for a while. There'll be a correction, evaluation, change of the guards, money made, money lost. Another Tuesday at the office.
Tell us.
Yep.
What would happen if, for election purposes, they will inject more money to make it look better? Then we will.
They're not supposed to do that. Okay, I'm just going to say the supposedly the Federal Reserve and the U.S. presidency are separated. This is a comment that's been brought up more and more lately, right? Were the interest rates held artificially low in favor of the incumbent president in the last election? I don't know. I can't say that they were or they were not. All I can say is that the interest rates were low. Why were they low? I'm not going there. Right now, if the interest rates are lowered or do some other pattern than the normal pattern near and or around an election, I'm going to get quite suspicious.
Hey.
I am, but I'm not a conspiracy theorist, and I'm not going to sit here and say, the Fed's going to, mingle with this or that or mess with the rates and all that. They may not. I don't know. Honestly, I don't really care. But if we see that data is apparent, then I am a man of science and data, and I will read the data like everyone else. But hopefully the system is separated as a
that's what I was just gonna go to. It's data driven. We just have to watch the data and then understand
that's
what's happening, and then make decisions from what we're understanding.
Exactly. And if you just because you're following the data doesn't mean you're not a conspiracy theorist. But if you're not following the data, you're definitely a conspiracy theorist. I'm going to make that comment. So at least follow the data. At least know your numbers. You might still be crazy and misinterpret data. That's fine. That's on you. But at least just know your numbers. That's all I'm saying. Then I'll respect your
question that everybody asks, that if they find out that I know you and you are my coach, is Bill buying right now? What is Bill doing?
Bill's looking like crazy. I am. I'm in. I'm looking. Same answer that I give everybody that asks me that question. I'm not retired at the beach or anything like that. I have sold everything more recently, yes. And I am looking, but it's the same answer I give everybody. I know what a good deal is. And technically, all of the conversation we've had up to this point is irrelevant. Market cycles, interest rates, the market's up, who cares? A good deal is a good deal. Doesn't matter what day of the week it is, right? I mean, it's so what? I mean, it's like if a deal makes sense, it makes money, and I can get a good loan, buy it. That's a good deal. Who cares? So that's where I'm at. Now, am I seeing a lot of what I think are good deals? No. I'm not seeing a lot of prospects that I'm saying, that's a great deal. And so I am making offers that make those deals good deals. No, I'm not getting a lot of those offers accepted, which is usually a follow-up question to that. No. So yes, I'm looking. Yes, I'm making offers, low offers, or right valued offers. Let's call it that way. Let's, real offers at the real value of the property. Yes, I am doing that. But am I closing?
So question is that people are going to ask me low offers. How much lower are you offering from the asking price? Is it 90%?
Easy. 1.25 debt service ratio with a 25% down payment on the NOI, calling it with current interest rates. That's my standard offer to almost anything out there, right? I want to go to the bank and I want to put out 25, maybe 30% if it's a nice property, right? And so what I'm telling the realtor is there are two levers we can pull to make a deal work, and it's price or down payment. And I am not going to I'm not going to use down payment to solve your pricing problem, right? So I'm not going further than, let's call it 30% down. And I know for me to go get a normal loan at a normal lending office, I need that property to be at a 1.25 or greater debt service ratio on the seller's NOI. So you tell me what I'm paying. I can go to any realtor and go, here's my offer right now. 1.25 debt ratio, today's interest rate, 25% down. You tell me. There's my offer. On anything you want to bring me, there's my offer. Right now. And then people usually follow up like, oh, gosh, are you getting this offer accepted? No, of course not. Definitely not. Because those are good numbers, right? No, I'm not getting those offers accepted. But that's a good deal to me. Period. If I see it on
and you're writing it down and writing down an LOI. So when they are in trouble, they can call you back.
Yes. Correct. Great point. Yes. Make offers in writing. They're breadcrumb trails. If you don't put something in writing, the probability that individual reaches back out to you in the future is very, very low. But if you submit an LOI, it increases tremendously the probability that person will reach out to you if their situation changes. Not everybody's does, but who knows? I think maybe some of this workout that we might see in the future here in the next couple of months might be short sales. Might be the lender and the seller getting together going, yes, we collectively will accept this low offer in lieu of us just going ahead and foreclosing and then selling the damn property at that price anyway, right? Why don't we just skip all this, go to the chase, short sale? Those are possibilities. And that is where if you've made an offer and that seller can't sell at the moment because maybe the bank hasn't gotten there, but then if they get there, the bank says, all right, look, just take offers. And they go, oh, well, hey, Bill, Lidiya, and Mina have called up. Here's an offer. Can we take this one? You get a phone call.
That's great.
That's exciting. So we're going to talk more about how we know you in another episode, but tell the audience where can they find you.
Sure.
And yes, all of that good stuff.
Absolutely. Well, I have two books on Amazon. You have right there. They're Real Estate Raw and Creative Cash. So those both on Amazon. Please look those up. My website is realestateraw.com, and it's the same title as the book there. I have a free blog on there. I've got probably another book's worth of articles on the website, videos, all of that. So just go to realestateraw.com. Check me out there. Check out the blog. I do have a coaching program or mentor program. You can take a look at there. I won't give you a big sales pitch, but you can go in there and check that out. And email bill@gobroadwell.com. Just send me an email, bill@gobroadwell, Go Broadwell.
And Bill, you write these books, no AI, no ChatGPT.
No ChatGPT.
That's a good point. Yes, I personally wrote those books. Yeah, there's $1 million idea right there. We're going to need now going forward some sort of like certification sticker that somebody can sell that says, human written, and yeah, you're like, as seen on TV or something, right? I can stick it on there.
There
I
is an
wrote
app
these
for
books,
that, Bill.
certified. Yes, they're not AI written. I don't use AI for anything of that nature. Everything is personally written, self-written. I think it's going to have to be the stamp we're going to put on stuff like that. Yeah, I wrote every single sentence of both of those books.
I was saying there's an app for that, Bill, that they check if it's human written or if it's a computer. Yeah, there's an
there
app
we go.
for that.
Perfect. Yeah.
But now
that.
they're creating an app that hacks that app. So who knows,
Of course. And then we need the app to get the app that gets the app.
All right. Well, thank you for coming, and we really appreciate that. But before I let you go, is because we have passive investors who like to invest. Can people invest with you in your projects?
Sure.
Yes.
You absolutely. If you want to talk to me about investing, I'm gonna send you to a different website. Go to Broadwell Property Group. That is my business website, right? The Real Estate Raw is the education side. So if you're looking for information, education, go to Real Estate Raw. If you're looking to just actively invest, go to BroadwellPropertyGroup.com. There's a little button up top that says Invest with Us. Click on that, and that gets you into our system. It'll send you a questionnaire, fill that out, and then I will be getting on the phone call with you very shortly after that. So yeah, please fill out that system. That legally starts the process of a relationship. So that's why I have that button, and that's why I say, hey, go over there and click on that. It just establishes our legal relationship going forward. So I get to show you all the deals I find in the future. Cool. So please click on that button.
And we'll put all those links in the description.
Thanks.
Absolutely. Yeah. Thank you. Appreciate it.
Thank you.
Absolutely.
Thank you for coming.
You're welcome. Take care.